Semiconductor stocks surging after the U.S. launched a new probe into China's chip manufacturing. We'll dive into those moves in just a moment, as you're seeing there. But first, staples. Down today, the worst performing sector in the entire S&P. Outsized losses in names like spirits maker Brown-Forman, Walgreens, Boots Alliance, Dollar General. That coming as 10-year yields tick higher again, briefly touching the 4.6 mark. Again, a level not seen since late May. The dollar also trading higher, trading near more than 2-year highs at this point. So what do all of these moves signal is in store for the new year? Dan, please kick us off.
Yeah, no, I know we're going to focus on chips a little bit. I think that's where a lot of folks expect a lot of leadership to be, right? There's one secular shift that seems to be driving a whole heck of a lot of technologies. So I think about Taiwan Semi, they are in the catbird seat as it relates to manufacturing of high-end GPUs. I think a lot of folks think that NVIDIA and Broadcom are going to continue to lead there. I just say this, that money came out of NVIDIA clearly into Broadcom. If you look at the SMH, the ETF that tracks the semiconductor space, they seem to be going sideways. Hasn't made a whole heck of a lot of progress in the last few months, despite some breakouts like a name like Broadcom. So I would expect investors to maybe early January, maybe take some profits. They're trying to hold on to some of those names that have had these massive gains into the new year. But then at some point, if we do have a sell-off broadly on some of these names that have obviously been very crowded, then you'll see money come back into them. As long as Q1 earnings guidance is not disappointing relative to, let's say, where valuations are and expectations are.
Guy, the
yes,
consumer
sir.
staples.
By the way, also on the desk tonight is that sweater that you're wearing. I mean,
yes, you like this has been approved because it's holiday.
Oh, it's beautiful.
It is. I'm just saying it was approved here. I'll wear a sweater tomorrow as well when I'm on closing bell overtime. It's just the holiday season for me. Anyway, Guy, if you look at the consumer staples trade, technology we've talked about ad nauseum for so much of this year. The staples trade, though, is it as attractive given the fact that yields just keep going higher and higher? We don't need those staples in their dividend yields. We can just get them in treasuries.
I think that's right. And I think the yield story is one that, not enough people are talking about. They're starting to talk about it now. And, you look at a 10-year yield of 4.6%. I'm of the belief, and I've been of the belief for a while, if you want to throw a TLT chart, you can see the levels that we saw last fall, so October of 2023, sort of 82 or so. I think that's where the TLT is headed, which puts us probably close to 4.9% in the 10-year. And I think the market's going to actually start taking notice in a meaningful way. And to your point, dividend stocks, which may have been attractive, 1% or so ago, are no longer all that attractive. On top of which, what you said and Dan mentioned, the strength in the dollar is a headwind as well. So you got to take notice. I know the S&P had a nice day today, but below the surface, there's some damaging things that are happening.
It's not, though, just all consumer staples. I mean, look at Walmart and Costco. They've done pretty darn well, Steve. So how exactly does that staples trade play out?
Yeah, so you're talking about large cap staples names, too. But if you look at the index, or the ETF that you're talking about, the XLP, we stopped, or we should stop, around this level. If you look back, August 5th in 24, this is where you have some congestion in the charts. This is where you have some flattening out. So you should theoretically see the market stabilize here, especially in the staples. I think rates will eventually start to come in. I think it's a product of the 10-year is more about future growth. It's more about inflation expectations. The shorter end of the curve is more about the Fed, obviously. We've had an incredible run off the election. There was a lot of market uncertainty. I agree with the guys. I think the market should come in.
The market should come in, but
should come in, but not crazy. I think we'd all feel happy about probably another 5% lower to create a sense of urgency for people to get off and say, you know what, let me try to pick values where I perceive there to be values and to bargain hunt a little bit. And the valuation's a little steep in the overall market.